The current price of Supermicro Computer Inc. Arxer trading under the ticker SMCI stands at $27.37 per share as of the midday session on Wednesday, April 29, 2026. The stock is down 1.72% on the day, extending what has been an extended period of volatility and sustained weakness that continues to leave investors questioning whether the company is approaching a durable bottom or whether additional downside still remains ahead. At first glance, a move of less than 2% may appear relatively minor in isolation, but within the broader context of Supermicro's recent price action, it reflects a market that remains highly uncertain about how to value one of the fastest-growing infrastructure companies in the AI ecosystem. The central issue surrounding SMCI is the extraordinary disconnect between the company's underlying business performance and the way the equity market is currently pricing the stock. In most situations, when investors see a company trading more than 50% below its 52-week highs, the assumption is straightforward. Something in the business model is broken, revenue is deteriorating, margins are collapsing beyond repair, or competitive pressures are permanently impairing the long-term outlook. In the case of Supermicro, however, the underlying fundamentals tell a far more complicated story. This is a company that recently delivered 123% year-over-year revenue growth and generated more than $12.6 billion in quarterly revenue, numbers that would typically command premium valuation multiples across the technology sector. Yet despite that performance, the stock continues to trade as though the market believes the business is entering structural decline. That gap between operational momentum and market perception is where both the opportunity and the risk now exist. Much of the bearish narrative currently surrounding Supermicro stems from the combination of legal overhang, margin compression, and investor distrust regarding the sustainability of current earnings. The company remains under pressure from multiple securities-related legal challenges, with law firms including Rosen and Robbins Geller circulating class action notices tied to a May 26th deadline for lead plaintiffs. Whether those cases ultimately prove material or not, their presence alone creates a substantial overhang on the stock. Large institutional allocators, including funds operating within platforms such as Fidelity Investments or Schwab Intelligent Portfolios, often avoid increasing exposure to companies facing active securities litigation until greater legal clarity is established. That reluctance from institutional capital can suppress valuation multiples, even when the underlying business remains fundamentally strong. At the same time, however, focusing solely on the legal headlines risks missing the broader strategic picture. Supermicro has increasingly positioned itself as one of the foundational infrastructure providers, enabling the next phase of global AI data center expansion. The company is no longer merely a server assembler in the traditional sense. It has evolved into a highly specialized infrastructure solutions provider whose products increasingly sit at the center of modern hyperscale and enterprise AI deployments. This is particularly true in liquid cooling, where Supermicro has established a meaningful competitive advantage as data center operators seek more efficient ways to manage thermal output from increasingly power-dense GPU clusters. That is why the market's current treatment of the company is so unusual. On one side, investors see governance concerns, legal scrutiny, and margin pressure. On the other side, they see one of the most strategically important hardware vendors participating directly in one of the largest infrastructure build-outs in modern technology history. The tension between those two realities is what has created the current valuation disconnect. Recent trading activity provides additional insight into sentiment dynamics. Daily trading volume has averaged approximately 23 to 24 million shares in recent sessions, notably below the roughly 35 million share average seen earlier in the year. That decline in volume matters because it suggests the most aggressive panic selling may be beginning to subside. Heavy volume declines during prior weakness indicated forced liquidation and widespread fear. Lower relative volume now may imply that sellers are becoming exhausted and that the market is entering a period of price discovery rather than capitulation. From a technical perspective, the stock appears to be attempting to establish support near the $26.50 level. That price has emerged as a critical line in the sand for market participants. If SMCI can hold above that level and build a sustained base, it may indicate that downside momentum is moderating and buyers are beginning to defend the stock at current valuations. If that support fails decisively, however, it would likely signal that the market remains unconvinced that valuation has reached attractive enough levels to offset near-term uncertainty. Institutional ownership remains elevated at approximately 54%, which is important because it demonstrates that despite the recent sell-off, large professional investors have not abandoned the stock entirely. However, the number of long-only holders has declined, suggesting institutions are trimming exposure rather than fully capitulating. In practical terms, that indicates many funds are reducing position sizes while waiting for greater clarity rather than exiting the name outright. Their focus is now squarely on the company's upcoming fiscal Q3 earnings report scheduled for May 5th. That earnings release is likely to serve as the next major inflection point for the stock and could determine whether the current consolidation evolves into stabilization or renewed downside. At the center of the long-term thesis is Supermicro's data center building block solution strategy, commonly referred to as DCBS. This strategic framework represents the company's shift away from being viewed merely as a component or server vendor. Rather than simply selling individual servers, Supermicro is increasingly delivering integrated infrastructure ecosystems that combine server hardware, liquid cooling systems, power management solutions, rack architecture, and infrastructure software into unified deployment packages. This is a materially different business model than traditional commodity hardware manufacturing because it positions the company deeper within customer infrastructure stacks. That distinction matters because integrated infrastructure solutions typically command stronger strategic value than standalone hardware sales. Once a hyperscaler, enterprise, or data center operator builds infrastructure around a specific rack architecture and cooling ecosystem, switching costs become significantly higher. Replacing a server vendor is relatively simple. Replacing an entire rack-scale architecture integrated into a data center build-out is far more disruptive and expensive. Supermicro's strategy is built around embedding itself deeply enough into customer deployments that future replacement becomes economically unattractive. The principal concern from the market is that the company's gross margins have fallen from approximately 9.5% to around 6.4%. In most circumstances, such compression would be interpreted as evidence of deteriorating pricing power or increasing commoditization. However, management's positioning suggests that the compression may be at least partially strategic. Supermicro appears willing to accept lower near-term margins in order to aggressively capture market share during the NVIDIA Blackwell Ultra deployment cycle. The company's objective is clear: prioritize speed to market,